Welcome, my name is Vishal Texanani. Today I'm speaking to Richard Hemming, editor at Under the Radar Report. Under the Radar is one of nabtrade's newest content partners, and I'm really excited to be working with Richard to bring some of their small cap recommendations, portfolio analysis commentary, and sector commentary to you, our customers. Richard, great to have you here. How are you?
Oh, great. It's great to be in nabtrade.
Fantastic. Welcome. So Richard, can you give our investors a bit of a background on Under the Radar?
Well, Under the Radar historically has pursued a small caps niche simply because small caps are, produce big growth, which is ultimately what share investors are looking for. And because historically, from being an analyst, I know that it's just not covered. So we're all about giving the mum and dad investor access to stocks that aren't provided for anywhere else in terms of research.
Okay, so it's the return potential, it's the fact that they're not covered by a lot of the analysts there. It's also diversification, right?
Well, diversification is important because in the ASX, it's one of the most concentrated markets in the world. Something like 80% of the market capitalization is contained within 20 of the biggest stocks. So small caps gives you huge diversified sort of exposure to different types of companies, different industries. And also you get, different business models which have much more operating leverage. So they can grow more. Off a smaller asset base, they can double, triple and more.
Okay, great. So can you explain to our investors, how do you find your opportunities and what are the fundamentals you look at?
Well, we do a lot of screening because it sorts them out quite quickly into stocks that haven't got debt problems, stocks that are producing sales growth, stocks that are profitable. But ultimately, after that screening process, we have to go and analyse the stocks, and we categorise them into 4 different areas. Basically, we're after high growth stocks. You can't always find that, but when you can, it's good. But often high growth stocks are overpriced. So typically, a lot of our companies are value orientated, and they're considered quite boring by the market, but they produce consistent profits, and they're kind of not really well known. These companies can produce really good returns, and also there's fallen angels and special situations.
Okay. And you give these companies a rating, right? How should people interpret the ratings when they read your reports?
Well, we have buy, sell, hold recommendations that are very clear. Sometimes with a speculative buy scenario, that means that there's a binary outcome. So with a biotech or a medtech, you stand to make a lot of money, but there's a higher degree of risk. With a take profit, sometimes you're taking risk off the table, but you're leaving your profit, you're leaving your costs, you're taking your costs out and you're leaving your profits run. So you're taking risk off the table, which is often for small caps a good thing to do because some of them don't produce dividends.
Okay. Talk to our investors about what your hit rate, your success rate has been in the recommendations you've made, and perhaps the best recommendation you've made and the worst recommendation you've made, and what the lessons were from those.
Well, we've been around for 8 years, and we've done something like 300 recommendations. Our average return on those recommendations is around 35%.
Yeah, wow.
So at the top end of the scenario, you've probably got Northern Star, which produced a 10-bagger return. And when we first looked at it, it was sort of a case of a hidden asset with the Paulsens mine not having much of a mine life. But then, Bill Beeman, the chairman, really did have a good knowledge of underground mining. So we talked to him a lot, and we gained comfortable with the risks there. And then on the other side of the equation, on the stocks that haven't performed well, we got caught out, like most people in the market, with the mining services. So with contractors, you have to be very careful.
And that's RCR Tomlinson.
And RCR
right?
Tomlinson, we got out at $3, but it just shows you how quickly things can turn south when there's a mismatch of liabilities and assets.
Okay.
So you have to be very careful on the debt side of the equation and cash flow.
Of course, and that's why for small cap investors, it's important to be cognizant that there's an extra layer of risk, and that's why diversification is so important, and portfolio sizing, right?
Yeah, we advocate investors over time own 7 to 10 stocks, and that small caps represent 25% of the portfolio.
Okay. Richard, thank you so much for coming in, sharing your insights. I'm really looking forward to working with you to bring your recommendations to our investors.
Thank you so much.
No worries. I hope you found this video informative. Now, please remember what we talked about today isn't investment advice. If you're thinking about investing in small caps or any other listed security, please do your research and consider seeking financial advice. My name is Vishal Texanani, and I'll see you next time.